We've just initiated coverage on telecommunications company OptiComm following their initial public offering on the ASX earlier this year. So in today's video, I'd like to talk to 4 key things about OptiComm. Number 1, what they do. Number 2, what we like about the company. Number 3, the key risks that investors need to be aware of. And 4th and finally, our investment view on the stock. So if we start with number 1, what OptiComm do. OptiComm build, own and operate wholesale fibre last mile connectivity that provides an internet connection to households around Australia. So they build these telecommunications networks on behalf of the developers. So these are in areas like broad acre and multi-dwelling units. So new households and new apartments being built and sold around Australia. So what's unique about OptiComm is that they're wholesale only. They don't deal directly with the household. So the household deals with the retail service providers, household names such as Ionet, iPrimus, Exetel, are fairly common household names here who the customer signs up with, and then those companies actually pay OptiComm for access to the fibre connecting to the house. So to put that in context, your average household probably pays $75 a month for a home internet connection to Ionet, and then Ionet's paying $50 of that $75 to OptiComm for access to the fibre all the way to that house in which the person resides. So what we like about OptiComm, OptiComm is a unique and attractive business. They get paid to build a network, and then they get paid a recurring monthly fee by third parties that want to access that network to service the household. So we think OptiComm's network has a really strong competitive position. It's typically the only provider of telecommunications networks in the areas where it's operating. And what that means, importantly for investors, is you're getting a 20-year plus useful life asset, which creates a strong recurring revenue stream. OptiComm also has a very large and growing pipeline of work. So if we assume all things remain constant at the rate of the FY20 forecast in the prospectus, effectively you're going to see 7 or 8 years of growth in this business in the recurring revenue stream. And what that means is you're going to see EBITDA tripling from current levels. So that's a pretty good outlook in the year ahead or the years ahead. All of that translates to a defendable company with strong growth and attractive financials. We know the numbers are good for OptiComm. The other thing that's attractive for investors is the fact that the board and senior management team own 47% of this company. So that's a significant alignment with shareholders. They're shareholders, as many of you are as well. So good alignment of shareholders, and equally importantly, when you've got that sort of structure, you've got management that is taking a long-term view in running this business, and value is created in creating a long-term view and executing on that. If we now move on to item number 3, which is the company's specific risks. Something we get questions about a lot from investors is the risk of an NBN write-down to lower last mile access costs, and also the risk of 5G or other wireless technologies substituting the need for fixed line connectivity. We're not overly concerned about either of those in the context of OptiComm, and we explain why in detail in our report. If we give you the short version now, number 1, the NBN. If you look at the NBN's business plan, you can work out that they need to generate at least $50 per active subscriber per month in order to cover just the cash costs of running the NBN. So that's not about getting a return on investment. It's not about having meaningful capital to invest in the NBN to improve the network over time. It's just about covering the cash costs of running the business according to the NBN. So unless taxpayers want to fund the NBN forever, then the NBN needs to generate at least that $50 a month per active customer. Coincidentally, that's about the ARPU now for OptiComm, so we find it very hard to see how that number is going to change materially from current levels, and obviously that's why we're not so concerned about the NBN side of things. If we look at 5G and wireless, I think this is not really a threat in the regional areas. It's a challenge certainly in some of the metro areas, but not so much so in the regional areas, and that's because for any of these wireless technologies to work, what you still need is substantial fibre optic cables, substantial mobile phone towers, and substantial power. So it's really the last mile that becomes wireless, but you still need the key infrastructure to support that. If you look at 4G towers, for instance, their coverage range is typically about 25 kilometres, which is a big area. But as you move to 5G, it's anywhere from 500 metres to 200 metres. So you're going to need multiples more, like 50 times more 5G towers than 4G towers, for instance, if you wanted to service the same population. So that's the first thing. The second thing here really is that 5G is economic in some instances, particularly metro areas where there's existing sunk fibre assets from telecommunication networks. So if you've already got towers, fibre and power, there's a small marginal bolt-on cost to upgrade to 5G, and therefore to get a return, you're not trying to get a return on the whole capital commitment, it's just that marginal expansion money. So it can work in those instances, but going back to OptiComm, what you find is OptiComm tends to be the sole provider of telecommunications in the areas where it's operating, which are further out of town. And if they're the only ones with the fibre networks, it's very hard to actually compete against that. Plus you need lots of towers and lots of power. So I just don't think the economics stack up in the more regional areas where OptiComm's networks operate. So we're not concerned particularly about 5G. We think that's a pretty low risk. The risks that we are more conscious of that investors do need to be aware of, however, are number one, the bush tax or the regional broadband scheme. This is a proposed tax on network operators like OptiComm. And the idea is that some of the very regional areas are uneconomic to run the networks, and therefore the metropolitan style areas should subsidise those areas. It's not new information. In fact, it was first proposed back in 2016 and it's effectively been parked ever since. However, what happened in July of 2019 is that our Communications Minister, Paul Fletcher, said it's back on the table. At this junction, that's about all we know. So details are clearly not clear. Our forecasts, however, do expense what we think the bush tax will be looking like from FY21 and beyond. So we're assuming it's in a similar form to what it was originally suggested, which is $7.10 per active subscriber over 25,000 subscribers. So we've expensed that through our forecasts, and we're hoping that that's the worst case scenario and that we've factored it in. However, we just don't know. This legislation has not been presented or passed yet. So as this legislation gets presented, we'll have more detail and we can adjust things accordingly, but just making sure people are aware of this. The second thing to be aware of is clearly the housing cycle and the construction cycle has ebbs and flows. People build more houses and less houses. That has an impact on the construction of the houses themselves and the fibre networks that OptiComm build to service those households. So if we're in a construction boom, OptiComm is likely to build more. If we're in a declining construction cycle, they're likely to build less. So you will get volatility on the construction side of things, both in houses or lots passed, but also potentially on the margin side of things. However, offsetting that, we have the recurring EBITDA, which is the monthly payments from active users. So just a couple of risks that investors need to be aware. Finally, number 4, our investment view on OptiComm. Well, we've just initiated coverage on the stock. We have initiated with a hold recommendation and a $3.45 price target. There's a lot to like about this business and we're certainly big supporters of the stock. However, it has rallied over 60% in the last month. So we're conscious that the valuation is now, in our view, looking reasonably full or reasonably fair for FY20 earnings. As we look further forward, we think there's upside there. But for now, we've initiated coverage with a hold recommendation and we would certainly be happy adding to positions if there is any weakness in the share price, all things being equal. Thank you.